Karibu everyone to the 2020 Black Blockchain Summit. With me here today is Mr. Reggie Middleton, the CEO of Veritasium, and we're going to be having an overarching look at the cryptocurrency ecosystem, as well as the world economy during this time of the COVID pandemic. So Reggie, it's great to have you back.
Thank you, it's great to be back.
So could you introduce yourself and tell us what you do?
I'm a serial entrepreneur. I think my birthday's coming up in about 2 weeks. I'll be 53. And the last time I had a W-2 style job that I could think of was 30 years ago when I was 23. So for better or for worse, with failures and successes, I've been an entrepreneur since I was 23 years old. I had a .com. I sold investment valuation analysis software. I invested my own capital. I've been shorting companies, banks, etc. I bought real estate in the New York area. Anybody who's from New York, they're familiar with downtown Brooklyn, Fort Greene, Clinton Hill, during the Bed-Stuy, during the 2000 to 2006, 2007 era. After doing a .com, having a child, staying at home and raising her, and that's my third child, by the way, and jumping into real estate, I caught that big boom, both the gentrification move and the credit bubble move. At about 2006, the bubble got ridiculous, and I figured out that 2 + 2 didn't equal 197. So I sold off the real estate holdings, even though they were designed to be a portfolio for family wealth for multiple generations. The math didn't make sense. And I shorted everybody who did business with me. That included Lehman Brothers, Bear Stearns, General Growth Properties, Washington Mutual, Countrywide, etc. Many of those companies are either non-existent or filed bankruptcy or collapsed and had to be bailed out. I also did very extensive research reports for those as well, because the goal was to create a hedge fund to get leverage to short everybody. But I am not the typical hedge fund manager demographic. From the way I look, talk, walk, speak, was schooled, etc. And so that didn't pan out, but the research did. I got a name in financial analysis and investment circles because outside of giving out 30 and 40 page or 20 page very detailed reports about these large institutions that have been in business for 50, 80, 100, 150 years and then collapsing, I was very prescient. I was also right. I rode that media wave and continued to give out research through a blog called Boom Bust Blog, which we just reopened just a couple of weeks ago, because we're in the exact same situation now that we were in 2007, just much worse. I caught the blockchain bug about June, mid-year 2013. Created the following year, I created a company, Veritasium, and that company was the blockchain engine that allowed us to attempt to monetize and solidify what we saw was the greatest thing that happened to the world since the internet. And here I am now. I wear multiple hats as a software developer and tech entrepreneur, as an investor, as a financial pundit, analyst, macroeconomic student, etc. I must say I've been pretty accurate in calling big macroeconomic booms and busts, successes and failures in companies, and countries as well, and even cities. Not because we're that smart or I'm that smart. I have a team of analysts that work for me. It's because I'm very objective. I approach this as an outsider. I don't have a dog in this fight. And so when I see a blue wall, I see the color blue. Other people who are paid to see the color red see a red wall, regardless of what color wall they're looking at. That's very important when you're taking advice or following advice of somebody, or even their opinion. You have to look for biases, and you have to look for reasons why they will give you other than the most objective answer they can. And that's Reggie Middleton in a nutshell.
All right. Um, I've been following you for about 9 years, and I think if you can if you can dive deep into sort of the prediction that you had made leading up to the 2008 financial crisis in the West, um, how are you able to sort of figure out, quite early before everyone else did, or before the main pundits on the market were able to figure out that there was going to be a huge crisis. I believe that started with Lehman Brothers and so on. So how are you able to make that prediction, and what parallels do you see between 2008 and 2020?
Okay. Well, they're not so much predictions, it's just reading. Like I said, I think I'm a bright guy, but I'm definitely not the smartest guy in the world. But I'm very objective. So a lot of entities um, that give advice, they give advice, they give the advice. So that means that that advice is basically marketing support for some other activity. For investment banks, the analytical arm is the marketing and sales support for sales, stock brokerage sales, investment management, and primarily underwriting, mergers and acquisitions, and um, underwriting of new companies. So they're not necessarily looking to tell the truth. They're looking to support revenue generation in the banks. So everybody has an angle. You're looking for somebody whose angle is to make the most amount of money as possible by buying or selling that stock for their own account, or that, not necessarily that stock, but anything for their own account. And then you want to be in the same side of the boat as they are. I don't have an investment bank. I don't have a stock brokerage firm or an exchange, so I don't have that bias. So when I look at something, I see what it is. Our analysts work 100% for me, and they'll do anything else but work for me. And we are dogged. So when we see, I'll give an example of the big banks. A lot of people say the big banks are very well capitalized, are um, uh, very well financed, as they said back in 2007 and 2008. So I'll run through a quick list of predictions then and predictions now, or should I say observations then and observations now, and I'll draw the parallel. Um, as I said, I bought real estate from 2000 to 2005, I think was the last purchase. Started selling off in 2006, and this was supposed to be a permanent portfolio. The reason was real estate values were going this way, right? Rents were going that way, and income relative to rents or affordability was going that way. Okay, unsustainable. It was sort of obvious what was going to happen, because in order to make money when you buy a building, you need somebody to pay the rent. They can't afford to pay the rent. Guess what? They don't pay it. So I shorted everybody. That included, again, Lehman Brothers, Bear Stearns, Washington Mutual, Countrywide. It was about, over the last 13 years or so, we made about 96 calls. During that period of 2007 to 2010-ish, 2009, we had a very, very high hit rate, considerably over 70% off the top of my head. And a lot of the companies that we called either went out of business, filed bankruptcy, or had to be bailed out. The reason was because they gathered a significant amount of debt to buy assets that depreciated in value significantly. Fast forward to today, you have a significant amount of debt, okay, purchasing assets that are overvalued, that are bound to fall, in price, because the price is one place and the valuation, actual economic valuation, is in another. In addition to that, though, the macroeconomic environment, see, the fundamental environment was the big issue back then. Plus, you had the top of the economic cycle, which runs roughly about every 10 years or so, booms and busts, hence the boom bust blog name. Now you have the top of the economic cycle. If it runs every 10 years, we're 12 years into it now, plus going into our 13th year, right? We passed the apex of the economic cycle. Okay, you have all this profited spending and behavior by companies and by banks. And you have the bursting of the bubble, because the Fed blew a bubble to prevent a significant complete crash from the last bubble popping, which was 2008. So all that activity, printing money, dropping interest rates, et cetera, the Fed was trying to taper it off, but as they started tapering off aggressively, The market's complaining, the Fed backed off. So we're sort of floating on fumes as it is. And then that bubble started popping again. Real estate values in the big cities were going down. Okay. The stock market was very, very highly valued, right? So it was ready to pop. And then COVID hit. Okay. COVID hit right after the everything bubble started to pop. I call it the everything bubble because usually you have a bubble in the stock market. And if there's a bubble in the stock market drops, money flies into bonds. You know, usually money goes from where it's not treated well to where it's treated well. Recently, over the last 7 to 10 years, you had the everything bubble where everything increased in price simultaneously. Commodities, bonds, stocks, real estate. So instead of having money go from one asset class to another, you just had everything that had any risk attached to it flying up in price. You don't have to be an expert in investment. All you have to just take your money, throw it somewhere, and it's going to ride the bubble up. Does that sound sustainable? A quick answer is no. Okay, so that started popping. Real estate in the New York metro area started going bust, particularly the high-end condo market, which is almost all of Manhattan, much of Brooklyn, etc. You had equities that were teetering, and you have bonds that have gone through what is now a 50-year bubble. Bond rates have been slowly trickling down for the last 50 or 60 years. So right before that bubble was really about to get going, COVID hit. And then you had this big shutdown, not only in the US, but worldwide. That shutdown caused a lot of economic malaise, a lot of unemployment, of course, but that created cover for the everything bubble that was popping anyway. So a lot of the pundits and a lot of those who are biased and get paid not to see the truth or not to convey the truth said that COVID started all this. And don't worry, it'll be a V-shaped recovery once, you know, you get a vaccine, COVID is over. That's nonsense because you have investment pundits now doubling and moonlighting as immunologists and virologists. Immunologists and virologists say this is a novel virus and we don't know exactly anything about it. Okay, a vaccine, even with fast tracking, would be a year or two at bare minimum off. And once you get that, right, the solution is still not there because you have to administer it, you have to see if it works, et cetera, et cetera. So that unrealistic euphoria of a V-shaped recovery, plus the Fed, who actually sees the truth, of course they never convey it, okay, completely, they decided to print more money in US dollars since October than has been printed in 40-something years. Okay, 40% of the monetary base has been added, right, to the world since October. Okay, that's absolutely unprecedented. It's never happened before in the US. Meanwhile, interest rates have become the lowest they've ever been, and risky asset prices have spiked higher than they've ever been. Okay, at the same time, the government starts to give away free money. It's never really done that before consistently, right? And unemployment has spiked higher than it's ever been in the history of this country, okay, since records have been keeping. So all of these all-time high bad news events, okay, and all-time high remedial events are happening. And at the same time, the stock market is flying up, okay? The reason is not because stocks are doing better, because the prices are going up, which makes the stocks more expensive, but their earnings potential are going down because of slower economic activity. You've had, you know, horrible GDP growth. The GDP has dropped more in the last quarter than it has in the history of this country, again. Okay, so all bad news, but the stock market's going up, which creates a super expensive stock market. So when the stock market goes up that way, earnings potential goes on that way, and unemployment goes down, and the economic activity goes down, you have a guaranteed crash that's going to happen. If that crash doesn't happen, then the stock market limps along until economic activity reaches stock prices 10, 15 years into the future. Look at Japan, where they had a lost decade, but that lost decade has lasted about 30 years. So with all these moving parts going forward, these predictions are like the 2008 crash on steroids. And I say predictions because you say predictions, but I like to use the word observations, right? These unbiased empirical observations show basically a depression coming. And this depression is not just in the US, but this is worldwide. The UK, which has a new spike, which has Again, a record drop in GDP that is never experienced before, including World War II and World War I. You have the EU, 16 nations, again, world record all-time high drop in GDP. You have the Asian nations, Japan, same thing, China, same thing, Korea, India. So the whole world is in a big mess. Add on top of that, that the US is in a particular position because it is the strongest economy. It has a reserve currency, which means it can abuse its currency and get away with it because everybody needs this currency to do global business. Okay, but it has the largest military and the most political influence, even though that's in question right now with the current administration, who I think has done a horrible job, but that's a different discussion. When you take a look at all this, the primary factor in getting past this, the first step is to get the virus under control, which the US is, of all developed nations, has done the worst. The reason is because the US is mired in politics and political struggle. So instead of taking a scientific method of eliminating the virus, they took a political method. And the virus and the issue of the virus and how to contain it and treat it has become a political football. Okay, the danger is the virus doesn't care at all what political party you belong to, whether you're left or right, conservative or liberal. An infection is an infection. That game has set the US back significantly. Okay, so where the US could have probably gained an extra 4 or 5 GDP points, instead it's playing political football and is setting the nation back, particularly small and medium-sized businesses, which suffer the most because they don't have the capital last like big businesses do. And considering that big businesses have the capital last, a lot of them are dropping like flies because at the same time, you have this COVID economic shutdown, you would have a sea change in the way business is done. Now, most business actually, is now done over the internet virtually, which means a lot of brick and mortar stores and a lot of companies that put large investments in retail spaces can heal. As a matter of fact, even without COVID, their days were numbered. I predicted the collapse of many retail spaces back in 2010. Okay, 2009, 2010, 2011. Fast forward 10 years, you have Century 21, Sears, Kmart. You have a variety of multiple businesses that don't have a strong enough internet presence to compete with the giants such as Amazon, Walmart, Target. So you have a structural change in the way of doing business. You have a macroeconomic slump. You have fundamental issues that are negative. You have demographic changes. These changes, demographic changes, are strongest in the cities where the big metropolitan areas, with New York being prime, #1 worldwide, has the strongest concentration of Fortune, say, 5,000 companies. If you want a worldwide presence and want to attract the best talent, you would probably locate in Manhattan or somewhere in Silicon Valley. Now that they've had the big lockdown and everybody's doing things over the internet, and many companies are given flexibility as to whether to come in for health reasons or for the fact that they realize that there's no reason to pay $500,000 a month for prime Manhattan real estate when you can have everybody work from home and it's just about as efficient, if not more efficient. So the world is changing at the same time that bubbles are busting, at the same time that a lot of people are getting sick, at the same time that a lot of people are losing jobs. So that's a very, I don't want to call it pessimistic view of the world, but again, a realistic view of the world. Now, during this, right, these massive times is when you have some of the greatest creations, the most significant creations of wealth in history. During the Great Depression, you had what used to be middle-class families eating dog food out of cans. You also had some of the greatest wealth created, dynastic family wealth created. Same thing during World War I. Same thing during the last big bust in 2008, right? A lot of people became very poor, but a small coterie of people became very, very wealthy. Okay, this is the time to learn how to concentrate your capital in the right places and benefit when these prices shoot up, and to avoid having your capital in things that drop to the ground.
Wow, that was a very elaborate sort of time lapse of what's been going on. So during the last financial crisis, 2008, is when Bitcoin, the idea of Bitcoin through the Satoshi Bitcoin white paper came out. And Satoshi, if I recall, on the first block of the Bitcoin blockchain, put a snapshot of a British paper called The Times, saying the Chancellor of the Bank of England bails out the banks again. So why do you think Bitcoin came at the very moment there was this huge financial crisis? And what do you see the role of Bitcoin being during this next financial crisis? This is because you're also calling this particular crisis a much bigger crisis than the last crisis, which brought Bitcoin. So what's going to come out of this financial crisis and depression that you're talking about?
Well, Bitcoin, it's obvious that Bitcoin was created as a solution to a significant problem. And the problem was having capital that had no sovereign rights. So when you have money, you put it in the bank, and the bank takes your money, pays you close to nothing for it, and then makes a lot with it. And they give you almost none of it in return. It's what I would call return-free risk. To explain to those who are not finance majors or well-versed in finance from a working perspective, there's a concept in finance called the risk-free rate, which is a fallacy, by the way. There's no such thing as a risk-free rate. There's always risk. Without risk, you have no return. So the only way that takes zero risk is to have zero return. But academically, you have a risk-free rate, which is a rate that governments give you, an interest rate that governments give you in order to borrow money from you. So in the US, that would be the treasury rate. Okay, let's say the 10-year treasury right now is also very low. I think it's just barely above 1% or 2%. That rate is categorized as being risk-free because the US will not default on it. That is not true. I'm going to give little finance lessons along the way. That is not true because the US has technically defaulted once, but it was minor. It was a political skirmish. But the reason why the US won't default on it, not because the US is so big and powerful economically, which it is because the US controls its own currency. Okay, and it's a currency that the whole world has to use. It's called the reserve currency, and you need to use it to buy stuff. So when the US comes into a financial burden, right, and they drop interest rates, if they still have a burden, then they print money. So if you borrow $10 from me, okay, and I have a problem paying you back that $10 plus 10% interest, so I owe you $11 by the end of the year. If times are getting a little hard, what I do is I simply print more US dollars. Okay, so now that $10, I print 10 more dollars, so now we have $20 in circulation. So I drop the value of the money in half. So when I pay you 10% on your $10, okay, you're only really getting 50 cents in interest instead of $1 in interest. So I just saved myself 50% of my debt service. And that $10 that you borrow, when you get it back, is only worth $5. So instead of getting $11 back, you're getting $5.50 back. The US is able to do that at will, okay? And they're doing it right now, by the way, printing large amounts of money with very, very low interest rates. So that in itself debunks the whole concept of risk-free rate, right? There's significant risk. Now, theoretically, the more risk you take, the more compensation you want to get for that risk that you take. So the riskier a bond is, the more money you take in. The riskier a stock is, the more of the return you're supposed to get. The riskier a cryptocurrency is, the more return you want for it. But the problem is banks have taken that out of your power, right? Out of your purview. So now basically you give your money to banks and that's it. So when banks, you take the risk of having your money in a risky bank and they do proprietary trading and risky lending, et cetera, and they give you basis points or 1% in interest, you're getting, instead of a risk-free return, you're getting what I call return-free risk, where you're taking the risk and getting no return from it. So Satoshi assuming he has a mindset similar to mine, says, you know, since we all have to take some risk, okay, but we all want some control of return, we're creating self-sovereign money. So Satoshi created a self-sovereign currency, money that is controlled by the users of the money itself and not by an authoritative centralized banking system. And that's the creation of Bitcoin. Okay, I was a very big believer of Bitcoin, 2013, 2014, much less so now though. And the reason is because the original premise of Bitcoin, self-sovereign currency, that allowed individuals to do business with each other, moving value, financial value back and forth, okay, through the blockchain without having to rely on a third party. That vision has been bastardized, it's been morphed, it's been changed by the system itself. Not the Bitcoin system, but the financial system. Most of Bitcoin's value right now and utility is not in peer-to-peer transactions in finance, but it's in speculation. Okay, people buy Bitcoin hoping Bitcoin goes up in value versus buying Bitcoin and to become their own self-sovereign bank. And so now you have applications for ETFs, you have over-the-counter funds, which are now very large, 10, 5, 10, 15, $20 billion. I forget how much they are. And basically, Bitcoin has been co-opted by either co-opted directly by Wall Street and or co-opted by the Wall Street mentality. Nothing necessarily wrong with that per se, except for the fact that it goes against the ethos of what Bitcoin is itself. Okay, now Ethereum and other currencies platforms, blockchain platforms, have come and taken over, and Ethereum has much more in the other currencies. I say Ethereum as a blanket for Ethereum and its potential competitors. They have much more development coming on board. Okay, so now instead of being purely a speculative vehicle, they are also a speculative vehicle, but much more so a utilitarian vehicle that are used to build distributed DeFi and other systems, of which Veritasium, which is one of my companies, is also through its hat in the ring, tokenizing real-world assets and allowing peer-to-peer transactions with real-world assets, again, without an authoritative third party. Now, let it be known that the government doesn't want this to happen, at least the U.S. government. There have been a lot of bad actors, in this space, but the government has pretty much went after practically all these small and not all the small capitalized or all the relatively small and relatively undercapitalized companies and giving them a very, very hard time. And hence you see a lot of these entrepreneurs are either not in the US or have been rolled over by the government. I was just right before this call, I see that the IRS has put out a call, an RFP for developers who can break the Monero encryption system, and also the Lightning system as well, which is the overlay for Bitcoin. Monero is a privacy coin, and again, things such as self-sovereign finance, private transactions, are things that the U.S. government, and I believe certain other governments, really don't want to see. The U.S. government has been very heavy-handed in this, in my opinion, and I believe they chased a lot of development offshore. Okay, but in a nutshell, that's where we're going from 2008 to now. There's been a lot of development, not nearly as much development in the States as it should have been, because the U.S. has been anti this. And the reason is, I guess some of the obvious reasons are the concern about fraud, money laundering, etc. Perfectly understandable, okay? But it has been my observation and experience that they've gone way past that. And so they've left the gate open for the big banks to take over and the big institutions. But the small entrepreneur, not very competitive. The US is not a good place to do business. So you will see Bitcoin 2.0, and you're seeing it now, but it will be ex-US. The reason is because this simply is not the place to create a business such as that. And that's in my personal opinion.
All right. So in a nutshell, we saw Bitcoin come from the 2008 crisis, and now we're beginning to see applications like DeFi being built on top of Ethereum during this crisis. So I think a lot of the things I'm seeing in DeFi were things that you've been talking about for the last 5 years. And I think you alluded to some of the challenges you've been having at Veritasium with the SEC. How is this space evolving to allow to more resilient development of these groundbreaking projects? And you say they're going to be built outside of the US. What are you seeing that is changing right now that will allow people like yourself and others to build these solutions to the challenges that we are facing on top of Bitcoin 2.0, as you called it?
Well, we've seen other jurisdictions become very, very welcoming to entrepreneurs. They're aware of basically the flight of talent out of the US, and many other jurisdictions have been very welcoming. Those jurisdictions have had problems, and primarily because the biggest concerns are money laundering and bad actors. They don't want that. Nobody wants that, at least if you're not a bad actor. Good guys don't want that, number one. Number two is competition with the existing banking system. When you create a new way of doing business and you cut out a lot of expense, you are also cutting out the people who profited from that expense. And those entities, the people that profit from that expense, usually are very powerful from a lobbying perspective. And they have control over the regulatory machine. Again, my personal opinion, I think we'd be hard pressed to find that to be wrong, but that is a problem other jurisdictions are having. But despite that, things are happening. They're happening at a much, much slower pace than they were before, but it will happen. At the same time, you have the established oligarchies, infrastructure, adopt technology as well. Okay, and they're using the technology to become more efficient, but there's going to be a hard ceiling, a hard stop on that increase in efficiency, because the majority of efficiency is the business model. They make money by standing in between me and you. So when I want to send something to you, I have to go through somebody who takes a piece of the pie out. Okay, despite the fact that the architecture is currently available, where I can send it directly to you and you can send it directly to me. We could create a program that allows us to do business on a very, very advanced scale, and we don't need those third parties. But those third parties have a lot of power, a lot of influence. So, as for how things are going to turn out, I think distributed systems, DeFi, peer-to-peer finance, self-sovereign banking is going to get a very big push soon, or a very big dose of recognition. The reason is because the banking system globally is in a very, very big hole. It's a lot of hot water, just like it was back then. Nobody's saying it now because, again, nobody wants to go through the books and dig through the fine print with their expertise. But if you take a look at the site, Boom Bust Blog, you can see an analysis of the Bank of America that had a ridiculously horrible quarter. Yet, all the analysts said they had a good quarter. If you go to my website, you can see, if you go to the YouTube channel, type in Reggie Middleton YouTube channel, you can see an analysis of JP Morgan, where everybody lauded they had such an excellent quarter. They had the worst quarter they've ever had, actually. You just simply have to take a look at the fine print. What banks are doing right now is the banks, we forecasted a significant degradation in credit. Basically, when people lose their jobs at the highest rate this country's ever seen, they're not going to pay their credit card bills. They're not going to pay a lot of bills. The last thing they skimp out on is rent or mortgages, but they skimp out on their cut back on a lot of the payments before they start paying mortgages and rent. And then eventually they start paying mortgages and rent. If you take a look at the credit metrics of the big banks like Citibank and Bank of America and JP Morgan, you see where their 30-day delinquencies have actually reduced from the previous quarter. So while everybody is losing their jobs and everybody's staying home and all these stores are closed and all these businesses are not operating, they're saying that more people are paying their bills on time than they were last quarter before the lockdown. And there's something wrong with that. The issue is it's accounting shenanigans. The government has forced the banks to issue forbearances. Forbearances when a lender says you don't have to pay this loan for X amount of time. and we're going to take the monies that you're supposed to pay into the loan and the interest you should have paid. We're going to put it on top of the loan's principal amount. So you just owe us more at the end of the year, but you don't have to worry about the monthly payments until that time comes at the end of the year. And we're not going to charge you penalties. If they do that, that means that the people can't afford the loan, okay, and they broke the contractual agreement. But the government is allowing banks that put these loans into forbearance to consider them being paid timely, okay? From an accounting perspective and legally, you could say that. Realistically, that's a lie, okay? If you're not paying timely, it's not paid timely. It's just that simple. So we're not talking one or two loans. With Bank of America, I think it was 27 or $37 billion worth of loans that they put into forbearance. I don't have the number off the top of my head, but you go to boombustblog.com, you go to the Reggie Middleton YouTube site, you can see, the full analysis, the almost full analysis. You can see the graphs and everything else. It's not just Bank of America. It's JP Morgan, which is Bank of America is the biggest lender in the United States. JP Morgan is the biggest asset-based bank in the United States. These big banks are having these problems. Imagine the smaller ones. If you go to the Veritasium site and go to the research tab, you can see how consumers were about to fall off a cliff anyway, and that's before COVID hit. You see they're ready to fall off. So when these banks are forced to face the piper, face the music, they're going to crunch and crash just like they did in 2008. They have a lot more liquidity now, but they also have a lot bigger problem than they did before, okay? And when you see confidence in the financial system shake, that's when confidence and curiosity, at least, in the distributed blockchain-based DeFi-style finance system will increase, just as it did in 2008. That is for sure, but then again, we have the issue of government regulation and unfairness, basically. Their job is to prevent the new, or at least their mindset appears to be, to prevent these new guys from coming in and taking over.
All right, so I think I saw the other day that Warren Buffett sold his airline stocks and his banking stocks and went to buy gold mining companies. And I know Veritasium has been working on digital assets that are backed by gold. So could you, give us sort of an overview, maybe not necessarily talking about a particular asset, of how a millennial like myself, who doesn't have, too much money, has maybe some, college debt, and so on and so forth, can thrive and can take advantage of what's, the opportunities that might arise out of the situation that we're in, and how, cryptocurrencies and DeFi also play into that.
That's a big ask in a diminishing amount of time, so I'm going to skim the surface. Warren Buffett is, I respect him, and he's a storied investor, but he's not a typical investor. Warren Buffett is one of the richest men in the world, so when he does something, it's almost preordained destiny. The fact that he did it means some markets simply moved to favor it. Now, that doesn't mean he was wrong. I'm 100% behind Slender Airlines. Being in banks right now is not a good place to be for a fundamental investor. Being in airlines is not a place to be. The reason is because people are just flying less. Number one, the COVID lockdown. Number two, it's now acceptable to have a Zoom call versus for me or you to meet in public and do this physically. I explained the downside of being in the banks. People are just going to stop paying their bills. And when they stop paying their bills, the collateral behind these loans are going to shrink in value, okay, because the economy is going to go down. Now, the key is to how to benefit from that. Warren Buffett uses massive amounts of capital. The average layperson has to be a little more discerning in how they go about it. The best bet is don't lose money. Risky assets, even though you see them going up in price a lot now, are not the place to be, right? Unless you're a very swift trader. They're going up simply because the Federal Reserve is goosing the system, right? They're throwing more money in. I explained that lending situation where I borrow $10 from you, but I create another $10 and now your $10 is only worth $5, right? By dropping the value of your money in order to get $10 worth of assets. Suppose you're buying a stock. In order to get $10 worth of stock, after I chop the currency value in half, you have to buy how much stock? If you want to get $10 of the stock, okay, and I doubled the amount of currency available. But so only way to get $10 of value of stock before it was doubled, how much stock would you have to buy? This is a quiz.
Come again?
If you would have wanted to buy, if right now we had stock, okay, you want to buy a stock of ReggieMiddleton.com, okay, it costs $10 now, but the government doubled the money supply, so they chopped the value of dollars in half, right? In order for you to buy $10 worth of $10 of Reggie Middleton value stock now, when the currency is chopped in half, how much of the stock would you have to buy?
You spend double the money.
Right. So basically, the value of Reggie Middleton, the price of Reggie Middleton stock went from $10 to $20. The value has stayed the same at $10, but the price went up to $20. That's what's happening in the stock market right now. A lot of people see the stocks going up and say, wow, the stock market is flying up in value. No, it's flying up in price because the dollars are worth that much less, so the stocks are being priced that much higher. But the value of the stocks in the stock market is actually going down because the economic outlook is horrible. You know, we just had 21 weeks, I think, since the COVID lockdown, 22 weeks, something like that. And we still had 881,000 people apply for unemployment. At that rate, it's still greater than any year in the history of record keeping in the US after 21 weeks of lockdown. So that means we're not even back to the level of the worst in the history of the US yet. We're still above that after 21 weeks. So anybody who believed that it was a V-shaped recovery is obviously wrong. So what you need to do is you need to find an asset that goes up when the value of currency goes down at the same time that economic activity wanes as well. You know, there's several reasons for the value of currency to go down. When the value of the currency goes down, you create inflation. That's a monetary inflation, but that is done to boost the economy. If it works, then the economic activity goes up as well. So things like real estate and stocks, which are sensitive to inflation, they go up in price and go up in value. That's not happening now. Now stocks are going up in price and going down in value simultaneously. Real estate is going, depending on where, right, is going down in price and value, but certain areas are going up in value and price. It gets complicated, and I'll give you a quick reason and I'll move forward. New York, for example, Manhattan was the most expensive real estate in New York City, and it still is. But after the COVID lockdown and everybody started working from home, and the density of Manhattan caused it to spread, and a lot of people realized that my companies allow me to work from home, hence I don't need to go to work. And these companies say, you don't have to go to work, and we're not going to pay for all this expensive lease space. People are moving out of Manhattan and into the suburbs, where the properties are cheaper, you have more space, etc. That caused the price of suburban housing to go up. Okay, a lot of people were very short-sighted, say, hey, real estate is booming, I'm going to buy more suburban houses. They forgot to look just 7 months ago, 8 months ago, where the price of suburban houses were falling. And the reason we're falling is because you're at the top of the real estate bubble, right, cycle, and it's going down. Suburbs temporarily going up in price, where the city centers are temporarily going down. After everybody rushes out of the city, what's going to happen? The prices are going to go down until economic activity supports the prices going up. And the only way for that to happen is employment goes up and wages go up and people make more money. No time soon. So the reason why Warren Buffett bought gold was because he's not a gold bug. He was actually very bearish on gold, definitely anti-gold for most of the time that I've known. And to be truthful, I am as well. I'm not a gold bug at all. But if you look at the numbers quantitatively, gold goes up when money supply goes up and the value of the dollar goes down and interest rates go down. Okay, so when you have monetary inflation go up and interest rates go down, right, the real value of rates, the real value of interest rates go negative or close to negative, gold goes up because gold is priced in US dollars. So when the US dollar becomes smaller in value and interest rates become low and unemployment goes up, gold basically stays still in price and value. But if gold stays still and what is priced in goes down, it looks like to everybody that what? The price of gold goes up,
Yeah.
which is the fundamental reason why he bought the gold miner. And the reason why we've been tokenizing gold since the summer of 2018. We started tokenizing gold when gold was $1,200 an ounce. Right now, I think gold is about $1,940 an ounce. It went up to 2,000 and change. It fell back down because those are just traders speculating. Don't worry about that volatility. Gold should go up more because the US dollar is going to be debased more. Interest rates are going to be suppressed. If you look at Bloomberg's blog for today, which is September 11th, 9/11, you will see the reason why interest rates are not going up anytime soon. And it's because the United States simply can't afford it. The United States has a record budget deficit. You know, it spent more money than it's ever spent since World War II on a nominal basis. Okay, meaning not adjusted for inflation. Yet its interest payments are lower, and they're getting lower. This is the cheapest, it's the least amount that the government has spent on its debt relative to the size of the economy. The reason is interest rates are very tiny, and it's even cheaper than that, but you don't see that in news articles because the government's printing money, so it's also not paying back the same value that it borrowed. Now, if interest rates were to go up, the government will have a problem affording this, and the government doesn't want that, so they will force interest rates down, and they will continue to print money, and that will continue to lift the price of gold. That's the fundamental reason for gold going up in price. But to go through other things and whether gold is suitable for somebody else, you know, I don't think of gold as an investment. I think of gold as a FX replacement, a currency replacement. So think of gold as a US dollar, euro, pound, renminbi, yen, okay, and how it floats among these currencies. Unlike the other currencies that have sovereign actors that want to drop the value of those currencies to give them a trading edge, gold simply exists. So it doesn't have as much manipulation in price as the dollar, the yen, the pound, etc.
All right.
It's very technical. So I apologize, but I want to dot the I's and cross the T's, if you understand what I'm saying.
Yeah, I think I understood. You explained it quite well, so I was able to follow quite a bit. So as we wind up, I know you've been doing some background, research, and also actually moving into the Caribbean and Africa. What are your thoughts for, I'm from Nairobi, Kenya, so I have a personal interest in this. What are your thoughts for the outlook of, the motherland, Africa, and the Caribbean, where you have some experience?
Well, I've spent a lot of time in Nairobi and in Lagos and other parts of Africa. I'm going to go brass tacks. It's Phil political correctness out the window. So, Africa is the wealthiest continent and the poorest continent at the same time, okay? And it doesn't have to be that way. It is that way because of colonialization, right? Now, everybody knows this, might not want to hear it, but it's a fact. Africa is still suffering from colonialization, right? Why? Because it is not monetizing its vast natural resources. Africa has much richer natural resources than everybody else, easily, okay? When the colonizers, right, run into big economic trouble, okay, this is an opportunity for Africa to pull out of the colonization's grip, the colonizers' grip. But you have to have the will to do it, right? Simply take your natural resources and sell them to the open market directly. Now, there are many machinations that prevent Africa from doing this, okay? But using current technology, right, the blockchain, et cetera, which a lot of African nations seem to be afraid of, right, you can do this relatively easily, right? Anybody who has a doubt or a question and wants to know how, simply call me. I'd love to speak to you, okay? If you go to the veritasium.com website, there's an application. There's a menu on the left. Click research, scroll down, and look at the research report for Zimbabwe, where we did an analysis of what would happen if Zimbabwe would adopt VE gold. Basically, it's a very gold-rich nation, very much like South Africa and Ghana, which is the #1 gold producer on the continent now. But Zimbabwe is fraught with hyperinflation, which makes no sense. It has the most stable currency backing commodity in the world, yet it has the highest rate of hyperinflation in the world for the longest amount of time as well. Okay, all they need to do is monetize their gold. Okay, we can actually create a gold currency. I can create it like that. Okay, that analysis is done. We can do the same with Ghana, Kenya, Nigeria. Okay, now when these companies, when these countries go and borrow from the IMF and the World Bank and other nations, they pay what I call a melanin tax. You know, Ghana pays roughly a 332 basis point premium on their borrowing relative to other countries ex-Africa with the same fundamental condition and economic level. So without any additional risk, it pays a 332 basis point, give or take, premium due to the melanin tax, right? There should be no melanin tax. There should be a melanin premium, okay? So, you know, this is possible, and there are a lot of politics that come into play, but the opportunity is here because the colonizing countries simply, you know, have their own mess to dig out of. Now, what will happen, I'm almost sure, is they will go and try and pull more value and natural resources out of Africa. But this is an opportunity to rewrite the rules. Remember, as I said before earlier in the recording, you have these big economic resets, or when a lot of people go poor and a lot of capital is drained out of certain areas, but some of the wealthiest dynasties are created. Okay, that's true not only on the personal finance level, but also on a sovereign finance level. So this is an opportunity for Africa to have its time in the sun as it did back during the pre-colonialization days.
Yeah. I think this is one of the silver linings of the corona pandemic, is that it's accelerating digitization and adoption of virtual commodities in Africa. So I think this is definitely the way to go. So as you conclude, you can give maybe your final parting thought to the Black Blockchain Summit. Yeah, so what's your parting thought?
Well, parting thought is unity, you know, umoja. The best way to create economic capital mass is to do business, okay? So I'm a Black man. This is the Black Blockchain Summit. I welcome all and any and all to come and do business with me. You don't have to be Black, you don't have to be African or from the African diaspora. You simply have to be aware and woke. We have significant financial research at Bloomberg's blog, independent, both free and paid. We have tokenized gold, we have tokenized silver. Silver's been on a tear because of its increase because of its volatility relative to gold. Okay, gold has went up, I think, 38% over the past year. Silver's went up 54%. Okay, but there's a whole lot more to the story than that, so don't rush it and buy silver. Okay, I'm just giving factoids and data points. And we have tokenized platinum, of which we are. I'm also willing to share a lot, and I also want to help sovereigns significantly. This is an opportunity for sovereigns to really rise. Hyperinflation should be a thing of the past. It is not necessary. Okay, citizens and residents who suffer from hyperinflationary countries don't have to, right? We have the solutions. I want everybody, whether you are just interested in dabbling for a couple of pennies or for, you know, a couple of $1 billion, you know, have a conversation with me. Come over, reach me on Bloomberg's blog at Veritasium. You can reach me on Twitter at Reggie Middleton, or email to me directly, Reggie@veritasium.com. Okay, and very soon at Reggie@bloombergsblog.com. Operating together and getting a true education is how you amass wealth, and this is a wealth amassing opportunity. Now, first you have to make sure you don't lose your capital. Okay, then you have to make sure that your capital is not lost to inflation, which it definitely is. If you keep it in US dollars, you are getting poorer by the minute, or definitely by the day, okay, at this particular juncture. And if you put your money in overpriced risky assets, right, you're going to lose it to the eventual depreciation of those assets, which is a nigh guarantee. So it's tricky, but actual real education, not necessarily academic, or definitely not academic. I'm going to be, again, politically incorrect. Definitely not academic, but real world education is the key. And perseverance, confidence, and patience.
All right, thank you very much. This has been the Black Blockchain Summit with Reggie Middleton. And I think I've learned a lot, and I'm sure you in the audience have also learned a lot. So thank you, Reggie, and till next time, Kwaheri.